Hey everyone, welcome back to Yuri's Box. In this video, I'm going to be looking at the week ahead for the S&P 500 and TLT. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So the week ahead is full of, we have a lot of data to, to put it bluntly. So we first start off with JOLTS, the JOLTS report on Tuesday, and this is actually for March. So we're kind of catching up because if you recall, the previous reads for the JOLTS report was always lagging by a month. So we're kind of catching up now, and we have it's kind of more relevant again because if you have data that comes out and it's 2 months old data, how relevant can it be? This time around, consensus is basically for job openings to be flat. Trading Economics has a forecast for the quits rate to be flat. Overall, as far as I'm concerned, the job openings isn't really a number I'm particularly excited about. Overall, the trend is lower. I expect that to continue. Now, where the next number will be, I have absolutely no idea. Overall, the job openings, the level of job openings, whenever we get a small bounce, that's usually when the media just goes nuts and says, "Oh, it's a red hot economy. Hold on to your boots. It's takeoff time." Then eventually it just goes down, and every time we get a bounce, you get the media getting, "Oh, it's a red hot economy. Takeoff time is imminent." So again, I really don't have any strong feelings in one way or the other as far as the job openings number is concerned. If you've been following my channel, you'll know I'm particularly fond of the quits rate, maybe even a bit too fond of. This is kind of my barometer of the economy. Given the fact that we have seen inflation, and again, this is 2.4, should be right here. Given the fact that in the month of March, inflation has gone down to 2.4, and given the fact there is a fairly nice correlation between quits rate and inflation, wherever the quits rate goes, inflation follows suit. I would not be surprised if the quits rate were to be back at 1.9, given the fact, again, that inflation did go lower. But I could also see it stay flat and perhaps resume its downward trend and actually make a new low, perhaps in April, But again, that is definitely getting too ahead of ourselves at that point. I would not be surprised, again, if we get a 1.9 read on the quits rate. But again, I wouldn't bet the family farm on that sort of stuff. Moving on, we do have more consumer surveys. Consensus is for 88.5 on the Conference Board consumer surveys. Keep an eye out for that. Then we move on to Wednesday, and Wednesday 30th we have a couple of GDP reads, as well as the ADP employment change. Now, ADP usually isn't it doesn't have a great correlation between the non-farm payroll number. All right, so just take it as an indication of the direction of where the non-farm payroll number could be. But again, remember, the best example I can give you is actually what we saw in the non-farm payroll number for October of 2024. ADP came in at something like 200K, if I'm not mistaken, and non-farm payroll still printed 12K. Again, was revised up to 36K, but regardless, there was a big spread between the two. So again, regardless of where the ADP comes out, I wouldn't get too excited about it. Now, we do have the read for GDP growth. Now, this actually, is a good segue for the Atlanta Fed GDP now. If you recall, the last time I made the videos, I was talking about the fact that we might get, eventually a bounce up to somewhere between -1% and 1%, or even -0.5 to +0.5, around that that range right there. You could argue that is what we got with the gold adjusted GDP now, because again, there was a lot of speculation that gold imports possibly skewed the read. On overall, I'm expecting the GDP number to be around, again, that range right there, somewhere between -1 and 1%. Could we see something stronger? Potentially. Again, I'm still in the camp that, we are in a slowdown, but it will take some time. It'll be a process. We won't get, just falling off a cliff. I mean, eventually, we will get to a point, if again we get to that recessionary environment where things start to, maybe something snaps, and you get again to the famous saying, slowly then suddenly. Granted, but I still think we're not quite there yet. The signal I would take from the GDP read on Wednesday is that last time in Q4 of 2024 we were at 2.4. If we were to get something like even 1.25, I would take that as a signal that we're slowing down. Right? That is the signal that you should take from it, in my opinion. I would not get too excited about it. And the thing you have to remember, of course, is that this read right here is for Q1, and Q1 is still doesn't reflect a lot of the tariff consequences that we'll potentially have to deal with later on this year. My best guess is that we'll start to see things, if things stay like this, granted, we'll start to see those effects starting in the summer. Again, I've been talking about the summertime well before tariffs. That is kind of my checkpoint for for the US economy, kind of June to August timeframe. So again, we could get anything between, I think, -1 and 1%. Overall, the signal, in my opinion, is simply that we're in a slowdown, and I wouldn't read too much into it, because again, we're still not in that recessionary environment. But again, we're in a slowdown. And again, if you keep slowing down, don't be surprised at where you get at, all right? The only thing you could also say is that, March did start to have a whiff of, that tariff uncertainty. So that could definitely have played a role in the GDP read. Regardless, I'm expecting it to come around somewhere between -1 and 1%. We'll see how it comes out. We also have PCE numbers come out on Wednesday. Usually that comes out on Thursday, though, if I'm not mistaken. Well, maybe it's my memory is just faulty. Again, we have PCE reads on Wednesday. If you recall, PPI came in cold, same as CPI, and we're expecting PCE to be more of the same, really. So I am a bit torn, because again, I think that if it were to come in hotter, it could have a negative effect. If it were to come in lower, I do see a path for the market kind of shrugging it off, simply because there currently still is a bias to having higher rates, because again, I think that the prevailing narrative right now is still that of higher inflation. And so the market could potentially look through it and say, yeah, things might be great now, but wait till the tariffs kick in and inflation is going to come running through, all right? Again, I'm usually, as if you've been following my previous videos, you'll know that I'm not personally of that opinion, but, market doesn't mean that market can't be of that opinion, and so that is one possible outcome. Regardless, we're expecting PCE to be at 0.1 compared to the 0.4 read we had for the month of February. Again, this is March data, not April. Then on Thursday, we have round of initial jobless claims, as well as a challenge job cuts read for layoffs. Forecasted for 290. I wouldn't be surprised if it's actually lower, right? I don't know. I don't have strong feelings about that. What I really be interested in seeing is the ISM PMI report. And again, the way you have to the disclaimer I like to make on ISM is that you basically have two reports, all right? You have ISM and the S&P PMIs. S&P PMIs tend to be a little more on the optimistic side. ISM usually tends to be a little bit more dramatic in its reads. So I would keep that in mind, regardless of the print. We're actually looking for a slight decline, and eventually that leads us to Friday, May 2nd. My personal forecast for non-farm payrolls is 75k on, again, non-farm payrolls, and 4.2% on the unemployment rate, barring any shenanigans in the labor force participation rate. If we see that tick up, I could see 4.3. I wouldn't expect a move up to 4.4 just yet. And again, how do I get to that, that forecast? As far as the non-farm payroll number is concerned, I just basically read the PMI reports and just go from there. Again, I didn't feel comfortable giving a forecast in March because of this phrase right here. Back in March, business activity growth picked up in March. Now, the rest of the report was, not good. Okay, it was still consistent with what we've been seeing since February, but you did have at least a hint that we saw growth pick up in the month of March, all right, compared to February. And I didn't feel comfortable giving a forecast because I thought we could see, either end of the spectrum, something negative because, again, the outlook is still negative, but because, you have at least some semblance of an indication that growth picked up in March, we could also see something ridiculous like 200K. So I didn't really feel comfortable with giving a forecast on the non-farm payroll side. This time around, we don't really have that indication of, at least some kind of a pickup in growth, for the month of April, and basically one of the important lines, at least, is right here. Although modest net increase in payroll numbers was recorded across the service sector in April, manufacturing jobs were cut for the first time since October. Hiring was often restricted by concerns over the economic outlook. All right, so again, I'm not expecting things to fall off a cliff. I'm not expecting things to boom. I think that 75K is kind of borderline between bad and good. It's, that's kind of what I'm expecting for the non-farm payroll report. Given the fact that yes, things still aren't looking good, and again, this is April, so if you have big hiring plans or investment plans, this isn't the greatest environment to be, expanding. So I think that we could see some kind of a pullback, still expanding, but meh is kind of the keyword, a keyword right there. So that's why I stand at 75K. As far as the unemployment rate is concerned, my general barometer for that is the initial jobless claims. Now, I've made the case why, initial jobless claims overall isn't the best, way to measure unemployment, given the fact that, you have many factors to consider. The fact that, you have low compensation rate on initial job, on the insurance claim of unemployment. So, you might as well just go and have a sidekick job in the gig economy, maybe drive for Uber, which offers significantly more. And so that is probably padding the numbers down a bit. Regardless, I just take them at face value for the unemployment rate. And if we have reads that are consistently below 215, we can generally expect the unemployment rate to go down. If you have anything above 220, or consistently above 220, you can expect the unemployment rate to go up. Again, we're still missing a few reads. Overall, unless we get something like, in the next few weeks, again, something crazy like up to 235 or 240 or 250, I don't know. I mean, I'm not expecting something that dramatic. I would expect us to hover around the 220, 230 range for the rest of April. And again, that just puts us where we've been for the most part of April. So I'm not expecting anything dramatic on the unemployment rate side, unless again we have something, some shenanigans in the labor force participation rate. All right, if we were to see the labor force participation rate tick up just by a little bit, then you could make the case for the unemployment rate to go up. Again, you could also see, anything. I mean, you could even see the opposite. Labor force participation rate, stay flat or even go lower, and you could still see the unemployment rate go up. But generally speaking, I'm not expecting the unemployment rate to move significantly. If it does, I would have a strong suspicion that it would be because of the labor force participation rate. And that is actually, one of the right calls I had last time, is that we would see an uptick in the unemployment rate because precisely of the labor force participation rate. It ticked back up, and we had a tick back up to 4.2%. Now, as far as the possible effects that the Nonfarm Payroll report would have, I will start at ground zero. All right. I think that unlike last month, this month's number will have an effect on markets. Again, last month I was really in the camp of fading the Nonfarm Payroll report regardless of where it was going to come out, because if you recall, it came out during the week of Liberation Day or Liquidation Day, depending on what you were longing or shorting. And therefore, the market would probably look through it. I don't think that would be the case this time. And again, whatever the number is, I do expect the market to take it seriously this time. All right, so we'll see how things evolve, and we'll see how how markets react. I would expect going down, to the nitty gritty of things. Starting off with TLT, if we were to get something again somewhere between around consensus, which means around 130 or below, I mean, I would expect us to be in an environment where bad news is actually bad news at this point. So if we would get bad read on employment, I would generally expect, barring again other exogenous factors like basis trade or forced liquidations like we had right here potentially. Again, I would expect that to be good news for bonds. So bad news is bad news, and good news is good news. So if you have a good read on the employment rate, that would actually just be a negative for bonds. And you could actually have, a scenario where maybe you just have to start considering this point right here, $82 on TLT. But that is, again, that is still potentially an ongoing process. So this week is kind of again, a decision point, really. It's, as they say, the most important employment report of our lives until the next one. And again, that's usually how things go. So again, I would think, unless we have some other crazy headline come out, like, Trump farts on national television, everything tanks. Of course, maybe even we go back to, Powell headlines and he wants to fire him. Again, that would be negative across the board. But again, barring, crazy headlines, I would expect us to slowly drift back to considering the fundamentals of the economy, meaning that actually bad news is bad news and good news is good news kind of environment, which would actually put, TLT higher in the case of bad news. All right, that's just how bonds work. On the S&P side of things, regardless of, I wouldn't say regardless. Here's what I'll say. Back here, I was actually calling for a rally up to 5,900. All right. We didn't get quite there yet, really. We got to about 5,800 on the S&P 500. I wouldn't be surprised if you actually see some follow through perhaps for let's say up until Wednesday to Thursday, and then it'll really depend on how the non-farm payroll report comes out. I wouldn't be surprised if we actually go close or near the 5,700 to 5,800 level. Mainly looking at the 5,700 level because we do have some confluence with the this trend line we broke down from in when was this? Well, really Liberation Day. We kind of flirted and again flirted with it quite a bit in the lead up to April 2nd. I wouldn't be surprised if we actually revisit it, retest it, potentially wick up to the 5,700 level, maybe even 5,800. And from then on, it'll really depend on where the non-farm payroll report comes out. Because again, my suspicion is that we're going to be in a bad news is bad news environment. Meaning, if we get something below consensus, below 130, and maybe the unemployment rate goes up, I would expect that to be a bad read for stocks as well. So perhaps we get up there and then we just have to face the music again, as I've been saying, as I've been arguing for quite a while. But again, that is getting way ahead of ourselves. Overall, I do see, let me put it like this. In the short term, there is a case to be made that the pain trade is up. Given the fact that right here, nobody wanted to, buy into stocks. In the short term. Now, the big caveat that I'll say to that is that even right here we saw buy the dip activity. You saw massive inflows from retail, and retail just bought dip. So I could see us going up simply because maybe there are more people at this point that are out of the market, and so that maybe they have to catch up. Maybe you see stocks go up and you say, oh, this is it, we're going back up, straight up to the moon, and so it just kind of sucks everybody in. But then potentially in the longer term, I would argue that the pain trade is lower, precisely because we continue to see this buy the dip activity, especially from retail. And usually that is what gets retail, well, kind of screwed, honestly, because if we are in an environment where the economy is slowing, eventually leading us into having to face the music that potentially we're going to see a recessionary environment in the US, well, then stocks will likely have to reprice lower. And so in the medium to long term, medium term, let's say, I would say that the pain move is lower. So short term, extremely short term, this week, we could still see some follow through, or in the following weeks, we could still see some follow through back up to the 58 max, I would imagine. But in the longer term, given everything we know about the economy, I would expect things to eventually reprice lower. And what I'll say to that, again, is something that I remind myself and I remind everybody of, is that you never go full macro. All right, just because you have hints that the economy might be slowing, that is not good enough of a reason to short stocks. All right. Stocks behave in really two manners. Number one, you have stocks really have to price in a recession. All right. So the world is imploding. It's the end of the world. And we have to price in the fact that the economy is going to go lower, all right? It's going to be in a recession, all right? And that is actually what we saw in that's the 2008 environment, all right? Overall, you had a peak, then, we had to buy the dip, but overall, eventually, the music stopped and, stocks had to reprice lower because of that. But in the absence of the hard data smacking you in the face or smacking stocks in the face, what do stocks do? They go up. That's all they do. I mean, and you can't really blame them, all right? That's what stocks do. So I'm not arguing for sure. I'd never argue for for shorting stocks, especially because, again, the only thing that stocks do is go up, all right? So just because you have a whiff or an idea or the sensation that the economy might be slowing, it's not good enough of a reason to, pile into the shorts, all right? And so that is actually another thing that actually plays in well with the idea that we might actually see some follow through to this rally. Now, again, we are heavily driven by headlines. And so again, something funky might be happening right now as I'm speaking. Whoever, we might even see a return by Peter Navarro, if that's his name. We actually haven't heard from him in about 2 weeks. Probably one of the things that I've agreed with. I heard a lot of people, especially Neil Dutter, who I look up to quite a lot, point out the fact that, ever since, a couple of weeks, we've had mostly Besant talk to the media. And we haven't really heard from the Hawks. We haven't heard from Lutnick. We haven't heard from Navarro. Who knows? Maybe we get, Revenge of the Sith. We get a return of the Hawks, Revenge of the Hawks, the trade Hawks, that is. And, maybe that derails everything. I don't know. So, again, we are heavily conditioned by headlines, so that could just throw a wrench in everything. Overall, again, just to summarize, we have a huge week ahead, which culminates on May 2nd with the Nonfarm Payroll report. Again, my general sensation is that the tariff drama is over, and by that I don't mean that tariffs are off the table, because again, when just going back to stocks for a minute, stocks have behaved as if we don't have tariffs anymore. We do have tariffs. We have a 10% baseline tariff on everyone, which is significantly higher compared to historic terms. So we still do have tariffs. I'm generally my expectations currently set is that the craziness of the tariff drama is probably behind us. And as we move forward, we'll have to just face the music. We'll just have to face the state of the economy. Now, I'm not necessarily saying that it's going to be bad. It could also be good. But again, we'll have to face it. We'll have to face whether it's good or bad. Well, again, we'll have to go back to focusing on the fundamentals of the economy as we move forward. And again, my thinking is that will culminate somewhere around the summer. All right, that was my expectation before tariff drama. It still is, even with the tariff drama, especially with the tariff drama. So that's where I stand with the stocks. Definitely don't short. Don't be a hero. And we could also see some significant, follow through to this rally right here. And then we'll have to reassess depending on where the Nonfarm Payroll report comes out. Same thing for TLT. The JOLTS report could move things. Inflation report could move things. But at the end of the day, wherever we stand on, Friday at 7 a.m. in the States, will really be irrelevant, mostly because, again, we could be significantly higher than where we are at 7 a.m. An hour and a half before the Nonfarm Payroll report, if the Nonfarm Payroll report comes in negative, and we could be significantly lower if the Nonfarm Payroll report comes in better than expected. All right, so really, it all kind of comes down to the most important jobs report of our life. Until the next one. If you like this kind of content, consider leaving a like and perhaps subscribing to the channel, and I'll see you next time. Bye.